So this is the second part of chapter 10. If we have a portfolio, we also want to calculate a beta of a portfolio, right? The way we do it is the way we calculate the expected return of a portfolio. Every stock's going to have its own weight, the percentage that we invest in every stock out of the total portfolio, and we multiply that weight times beta. Add them up, and that's it, right? Now, how can we calculate beta? Well, we can run a regression, or we can find it from several news outlets, right? You can go to Yahoo Finance or Morningstar or Bloomberg, and chances are that beta is gonna be available for you. Right? Now, a little bit more theory, something that I think it's important for you all to know. Let's talk about efficient markets. So this is one of the paradigms in finance. Markets are efficient, and by efficient we mean efficient with respect to pricing information, right? Uh, Now, this is a theory, so we need to have some very specific restrictions, right? There are many buyers and sellers. There are no barriers to entry, right? Anyone that wants to buy or sell will do it, right? Information is free and available to everyone, and there is no transaction cost. Now, we know that in reality, a lot of them don't hold, but this is a theory, and based on the theory, we can relax assumptions later and make decisions, right? Um, so the efficient market hypothesis pretty much says that prices are going to reflect all current available information, right? So we have three levels: the weak, semi-strong, and strong form. So the weak form reflects all information that we have had in the past. So we cannot beat the market if we rely on past information, right? Uh, if you are doing technical analysis, if you're analyzing trends and charts, you don't believe in weak form efficiency, right? Because the price today includes everything that has happened in the past. You cannot beat the market if you only use information from the past. Now, the semi-strong form, it says that you cannot beat the market because all of the prices right now reflect all public information, right? Public information includes historical information, right? Financial statements, news, analyst opinion, everything. Right? Everything is included in the current prices. So if you're doing fundamental analysis, if you're going through financial statements and trying to find cheaper stocks, you will not make it, right? According to this theory. Now, the strong form, it's all public and private information. Now, using private information, it's illegal, right? Uh, Not the top managers, but anyone associated with the top managers, right? If the CEO's son or daughter makes a trade 5 days before a major announcement, well, that's an insider, and that will count as insider trading, right? That is not the way. Our laws are structured in such a way that that should not happen, right? So that is for strong form efficiency. Now, this is a very important new, relatively new line of research in finance, which is called behavioral finance, right? So behavioral, well, we take behavior into account, right? The way people make decisions based on their psychological factors, right? Uh, all of the financial theories state that investors are rational and want to maximize their returns. In reality, investors are not rational and they are okay with a certain specific return, right? Optimism and pessimism can go way up or way down, right? Um, Sometimes we have people that are overconfident, right? Oh, I know the market really well. I will always make returns, right? Uh, Sometimes we don't take risk into account, and risk could be a very important factor in our returns, right? So if we have financial managers, we need to understand risk and return, right? We also need to know what stockholders expect from us, right? Um, and we need to be realistic in with that, right? Now, again, this is a way in which we can calculate required return. This is the same formula as in chapter 8, right? The return is equal to the dividend yield plus the growth rate, right? So it's going to be D1 divided by P0 plus G. there are two ways in which we can calculate return. One of them is through the